All right, now to an area of the market you might not be as familiar with, structured products. Now, they look to meet specific investor needs by providing investments facilitating customized risk-return objectives. Such products typically include a combination of assets linked to interest, as well as one or more derivatives. Yahoo Finance's executive editor Brian Sozzi sat down with DoubleLine structured products portfolio manager Ken Shinoda. Now, they covered all things from the housing market to portfolio allocations in an exclusive interview at DoubleLine's Investor Day. Take a listen.
One of the main things to think about right now is adding more interest rate risk to your portfolio. We are seeing a big move higher in both short-term and long-term rates. Last year, the 10-year Treasury yield got all the way up to about 430 intraday, and we had a pretty significant rally, almost 100 basis points down to the low to mid threes. And we've backed up since. We're almost back to 4%. So I feel like for those that missed that last chance when we were up here around 4%, it's an interesting time to think about adding long-term treasuries as a protection hedge in your portfolio to, potential further slowdown in the economy or the recession that keeps being pushed out, right?
Yeah, the recession we've been hearing about for 2 years or so. How do you see a recession in the cards?
I think that the economy has been more resilient than I think the market expected. I think part of the reason for that is that so many consumers and companies locked in really low cost of financing through either mortgages at 3%, 30-year fixed rate mortgages at 3%, and or issuing corporate bonds into the market. And so the Fed raising short-term rates, that has a lag that we've all, everyone's talking about. I think that lag perhaps is longer than we had thought because of all this kind of low-cost fixed rate debt that's out there. So I think it's just taking more time than people had expected, but there's definitely signs of weakening. LEI, leading economic indicators, just came in negative again. I mean, it's been like 5, 6, 7 months of continuous negative prints. So I think the economy is slowing. It started with the housing market. That reacts the quickest to interest rates. You're seeing slowdown in hiring and even layoffs in finance and tech. So it's almost kind of like this rolling recession that's been happening through different pockets of the economy.
So if we are going to get rates 5.5, I've seen commentary now 6% or so, what ripple effects does that have in the mortgage market?
So the higher rates go, the higher mortgage rates are, the first thing that happens is that the affordability collapses. So we saw a 40% increase in home prices over the last 2 years. You combine that, we saw mortgage rates going from 3% in the summer of 2021 all the way up to 7.25% last year. Housing activity basically came to a halt. So all the data that's things like existing home sales, new home sales, mortgage applications, all that stuff came to a screeching halt. I think you're starting to see signs of life now in the housing market. You saw pending home sales tick up a little bit. What's happening is I think that buyers and sellers are coming to grips with reality, right? Sellers want yesterday's prices. They're realizing, okay, I'm not gonna get yesterday's prices. I gotta, lower my offer down 10%. And buyers are realizing, that crash in housing that I thought was gonna happen, is it gonna happen? Sorry, millennials, right? And so mortgage rates also came down a little bit, and I think people are starting to transact. And I think that's good for home prices. I think they keep falling a little bit, but we're not going to see that, global financial crisis type 20-30% down nationwide.
And we have to give kudos where kudos is due. You called the housing market correction. You didn't call it a catastrophe. But if rates do go close to 6%, is there a catastrophe?
Well, we were there on mortgage rates. We were already at 7.25%.
7.25%.
Yeah, so we're down. We're in the low sixes now. Yeah, I mean, the higher rates go, the more pressure it puts on housing, but the problem that you're seeing nationwide is really just a lack of supply, right? You don't have the forced selling like you had during the global financial crisis, and we have been underbuilding homes over the last 10 years. And so, even if you, wanted to buy a house, sometimes you can't even go find the one you want. So lack of supply and that demographic demand of millennials, second largest generation since the baby boomers, it's going to support housing. Can you see 20% declines in some places that were super hot, like here in Tampa, we're sitting here? But it was up 40%. So if you're up 40 to 80% over 2 years and you correct down 20, it's not really the biggest deal unless you bought at the top. I think that's healthy for the housing market. It's a normalization. The post-COVID era just caused this crazy kind of bubble in a lot of assets, and I think housing is just coming back down to earth.
Is the housing correction over?
I still think it has room to run. There's a lot of new homes that were built, and I think that those homes need to get flushed to the market, and that's where the big discounting is going to come from. All the home builders saw the big run up in price. They all went out and started building supply to make profits off that run up in price. And now the supply is hit, but the demand is weak, and so they're going to have to cut those prices. So I think there's a little bit more room to run in the housing decline, but I think down 10% or so, a little bit more than that nationwide is probably where we shake out.
Is that 10% in prices?
10% in prices from the peak, which was last year. We're already down about 4%.
When do prices start to grow again?
I think rates stabilize here. I think they probably come down a little bit through the end of the year. Next year, the market's saying that the Fed's probably cutting next year now. It was thinking this year. And as interest rates come down and prices come down, affordability improves. And then I think you'll start to see home prices kind of flatten out again. There will be places that may not go down that much. There's places that could stabilize sooner because of demographic changes in demand. I mean, there's a lot of people that are coming down here to Florida. There's a lot of people moving to Texas. They're leaving high tax states like my wonderful California, that I love the weather, but I don't love the taxes. And so I think that, even if you go into a recession, there's still pockets of places in the U.S. that still have this demographic shift that's moving and will create growth and job opportunities that are not going to get hit as hard.
There are a lot of average investors that consume the DoubleLine content and your views and thoughts on the Yahoo Finance platform. How do they go upon investing in what you're talking about? Is there a couple simple tips or a couple simple ways they can go about this?
Yeah, I mean, one thing you can buy is just good old-fashioned bond funds that have not been popular. Not the risky stuff, more of your kind of traditional core plus. The bond market's been beaten up. The average dollar price of the different indices out there are now kind of in the low 90s. They were in the mid 80s back in October. I mean, that's a lot of convexity in the bond market. Everyone's favorite word, convexity, that hasn't existed for such a long time.
Let me Yahoo search that for a second.
Yeah, I'm teaching a class at USC, and that's one of the hardest concepts to teach the kids. But there's discounts everywhere in the bond market, so there's tons of opportunity. Rates have backed up to levels we hadn't seen in over a decade. You can buy high-quality bonds with 5, 6, 7% yield. You can buy riskier bonds for 9, 10% yield. These are equity-like returns I'm talking about, right? And there was, the old Tina mantra, there is an alternative, which piled everyone into equities for the last almost decade. That's over. Fixed income can now provide yield. It can provide protection, I think. Last year was a very unique year where bonds and stocks went down together. Part of it had to do with inflation. Part of it had to do with the Fed tightening. I think that the next time that we see a correction in equities, I think fixed income will do much better than it did than last year.
That was our Brian Sozzi there with DoubleLine Structured Products Portfolio Manager, Ken Shinoda. Thank you so much.